Every few months, markets around the world move trillions of dollars in a single day. Stocks surge, currencies collapse, crypto explodes or vanishes, and most people think it's random. It's not. Behind almost every major boom, every crash, every unexpected recession, there's a small group of institutions most people barely understand. They don't campaign, they don't run ads, they don't answer to voters, yet they quietly control the flow of money for the entire planet. These are central banks, and once you understand how they really operate, you'll never look at markets, or your own money, the same way again. Central banks were created to do one thing: stabilize the economy. At least that's the official story. Institutions like the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, they control interest rates, money supply, inflation, currency value. But here's the part most people miss. Central banks don't just respond to the economy, they shape it, quietly, indirectly, and often long before the public realizes what's happening. Have you ever noticed something strange? Markets often move before major announcements, stocks fall before rate hikes, currencies weaken before inflation data, risk assets rally before policy shifts. That's not coincidence, it's called forward guidance. Central banks rarely shock the market anymore. Instead, they signal a word here, a phrase there, a subtle change in tone. Statements like, "We remain data dependent," "Rates may stay higher for longer," "Transitory inflation." These aren't casual phrases, they're weapons. Because markets don't wait for action, they move on expectation, and central banks control expectations better than anyone. When a central bank raises interest rates, it does something simple. It makes money more expensive. Loans slow down, businesses hesitate, spending drops. When rates fall, credit expands, asset prices rise, risk-taking increases. But here's the part they don't say out loud. Interest rates don't affect everyone equally. Higher rates hurt workers, hurt small businesses, hurt borrowers. Lower rates boost asset owners, boost banks, boost large corporations, so every rate decision quietly redistributes wealth. Not by law, not by vote, but by math. After 2008, central banks unlocked a new level of power. Quantitative easing sounds technical, harmless. In reality, it's money creation on a historic scale. Central banks began buying government bonds, buying corporate debt, flooding financial systems with liquidity. Trillions of dollars appeared, digitally, no taxes raised, no votes held, and the effect was immediate. Stocks soared, real estate exploded, wealth inequality widened dramatically. If you owned assets, you got richer. If you didn't, you fell behind. This wasn't a side effect, it was the mechanism. When inflation rises, governments panic. But central banks, they often tolerate it, for a while. Why? Because inflation does something incredibly useful. It erodes debt. Government debt. Corporate debt. Even personal debt. Inflation quietly reduces the real value of what's owed. Your savings lose purchasing power. Your wages lag behind prices. But debt becomes easier to manage. Inflation is the only tax that doesn't need approval, and central banks control its speed. Central banks don't just control domestic economies. They shape global power dynamics. When the US Federal Reserve tightens policy, capital flows back to the dollar. Emerging markets suffer. Other central banks are forced to react. This is why a rate hike in Washington can crash currencies in Asia, trigger debt crises in Africa, force austerity in Europe. The dollar isn't just a currency, it's leverage, and the Federal Reserve knows it. Here's the uncomfortable question. If central banks exist to stabilize economies, why do crises keep happening? Because central banks don't optimize for fairness, they optimize for system survival. That means banks must be saved, governments must fund themselves, markets must remain functional. If that requires asset bubbles, inflation, sacrificing purchasing power, so be it. The system survives, individuals adjust. Central banks don't look powerful, they speak slowly, they publish reports, they avoid drama. That's intentional. True power doesn't announce itself, it operates through technical language, delayed effects, plausible deniability. By the time people feel the pain, the decision was made months or years earlier. Central banks are described as independent, but independent from what? They coordinate with governments, treasury departments, international institutions. They may not take direct orders, but their incentives are aligned. Debt must be managed, markets must remain calm, confidence must be preserved, at almost any cost. Central banks don't control your life directly. They don't tell you where to work. They don't decide what you buy. They do something far more effective. They control the cost of money, the reward for risk, the value of time. And once you understand that, you stop asking, why did the market move? And start asking, what is being guided? Central banks aren't villains. They're not heroes either. They are architects, quietly designing the system you live inside. And the moment you see the system, you stop reacting to it. You start navigating it. Because in a world run by invisible power, the real edge is awareness.